Hello guys, and glad to have you on board again today. Even though this says daily briefing, I will change this later on, and it is going to be a weekly briefing in here. A little bit of a delay, of course. I wish I could have recorded this one during the weekend, but totally was unable to. So anyway, with a little bit of a lag, we're going to try forecasting what are the most probable scenario for the week ahead. Indices first, and on a separate video I'll get to take care of cryptocurrencies. There's a lot to talk about in both of those things. But anyway, without any further notice, let's switch to context analysis. All right, we're going to introduce a new stuff in here, at least new organization of our context. Still the same thing in here. This is the Fear and Greed Index, but this is new, and this is going to be Retail Traders Sentiment Index, basically using IG market clients, CFD derivative clients mostly. And what you have in here is historical representations for the S&P 500, the one we care about, okay? So in here, you've got two elements. I'm just going to make it real simple. We're going to do a podcast, a trading lesson entirely on all about it and all the patterns you can highlight from this thing. But more importantly, you don't trade because of this, okay? This is just a risk management cursor. No more than anything, no more than that. It's just that we're going to either increase risk taking, or it is more used as a confirmation of the things that actually occur, okay? More of a trend confirmation or a range confirmation. And I would say that whatever we have out there is definitely a ranging confirmation, but I mean, I don't want to go into too much detail. What leads me to believe that is the key assessment. So what you have in here, these red to blue levels, just is the net expositions of retail traders for IG market traders. Though we have 40% of the net market exposure that is bearish, that is bullish. That means 60% bearish, okay? But on the opposite hand, on the bottom oscillator, you've got the number of traders. So you can definitely see that, yeah, we're getting real close to it. We just have a slightly bit more a downside trader. And actually, in terms of numbers, it is actually funny to see that it isn't 60-40. So it's just closer to it, of course. So don't mind me. But what really matters is the change we had recently, because we can see the motive has gone from a 20%, which means 80% selling volume on the S&P 500 as the market was into this absolutely staggeringly day after day low volatility stuff in which I told you don't sell. This is pointless. I mean, this is no market. But people were selling and selling harder and harder as we kept pushing. What matters out there to me is that as we actually reversed, when it actually mattered, start selling again, people were deciding to just cut the sell. So you can see the number of sellers rapidly fell. So this is exactly what we're talking about. And as the prices start to drop, we do have buyers getting in into a level faster than the one they did when they bought previously right in here. So it is interesting to see that pattern setting itself in motion. Because, of course, as the market tends to reverse, we see that at some point, retail traders will be even willing to buy. So if we were just pushing further to the downside, I can bet that they would definitely buy, which could fuel much more downside down the road. So it is a tough, complex question to answer right now. What are the retail traders about to do? Because we know that they're going to do it wrong. Are they going to buy or are they going to sell? I just don't know, but I think the smart money right now is just waiting for this. It's waiting for them to make stupid decisions so that they can actually profit take from them. That is my personal feeling, because I think the smart money is just assessing this right now. They probably want more panic, more fear in order to buy, so probably lower valuations. But that doesn't necessarily mean that. So many people think about it, but I think the smart money is willing to buy a sentiment and a drawdown that is going to be visible in the monthly charts, but no more than that. And in the meantime, if too many people are selling the support, they're probably just going to buy it out, cause some pullbacks, force some people to buy just to fuck up them later on. So I think this is a sentiment market, definitely the sign of a range, which means trading too much, trending into a range is the most stupid thing to do. So the actual question we're going to try figuring out this week is, after last week's invalidation, I was totally looking for breakouts, and I totally understood right by Friday that we definitely weren't into the right posture. So I decided to cut all those positions right on Friday, and the early Monday trading activity just says, all right, I was totally fucking right to do so. But right now, the question I need to figure out is this market actually reversing bullish or just I mean, after flushing the bears, we're just going to bring in the bulls. And I think that's exactly what we're doing today, bringing in the bulls to just fuck them up later on. So I think everyone will have its dose of being fucked up, because I still believe this is a range, but needs to be confirmed. So anyway, we're going to have a quick look at correlated assets in here, and as you can see, the Nikkei might be on the verge to invalidate me. I took this one and holded it over a week, so I'm eventually considering it getting out. We'll have a look at the charts. Otherwise, DAX and Euro stocks might be looking for rebounces, but as you can see, the VIX still fairly danger area out there, just like 30 bonds might be on the verge to bearish engulf yesterday's candle, which is Friday's. So from what I can see, we've tried breaking it to the upside, failed, and we might be just trying to the downside, which will be a continuation stuff. You can see that there has been 2 sets of waves to the downside. Since then, just a flat triangle, definitely on the verge for more downside to come on there. But I'm waiting for these signals to show up. But I can hardly see these markets going down and the stock market going up. That doesn't fit the plan. So lots of correlated assets, risk assets, just showing totally mitigated signals one way or another. So totally not flowing into an absolute bullishness to come in the stock market. So let's have a look at the stock market itself, by the way, and try and see what the technical signals are there, if they can orientate us either one way or another. All right, trying to answer this very tricky question, we're going to start first with the European session. Huge gap this Monday, totally followed through as the market opens with an absolute bullish gap. If you have a look at the daily structure, we've opened right on top with a massive gap. We've closed there, we've opened on top of Friday's high point, and we are now pushing hard. We even managed our way right up to this candle, retraced more than 50% of the initial bear move. In terms of weekly candle, that is freaking ugly. If that was a bottom, which means if we kept pushing further down the road for the German DAX, that would be a huge signals of invalidation for bears. Definitely something that will push us to historical highs later on. But the question is this another fucking trap? Do we actually need to buy the market in here, targeting new historical highs, or it is just a stupid trap? Because just if one day from now we would be there, all right, this would be an upper shadow candle. We would have an ugly body and trading down to the previous week's close. If we were just retracing there, just 400 points away, which is totally doable for the German DAX right by tomorrow. If we were just doing this, which means closing the gap, everyone will have a totally opposite feeling about the market right now, still leading me to believe that we're definitely oscillating across the 50. When we have a little bit of optimistic behavior, bam, we buy the shit like it's going to go up forever, and actually, bam, reverse, lose 3% the day right after, and the sentiment just rolls over to the totally opposite direction. So it definitely feels like a dumb trading activity to me. So I'm really willing to say and to wait for at least tomorrow to actually consider that the market is really going bullish, because I see absolutely nothing but just market making so far. And yeah, waiting for confirmations. But let me be honest, being a bearish in this type of market definitely doesn't work out. I can definitely see that the bears have gone out. Taking profit patterns out there could be at play if we actually were to validate these things today. So complex stuff to navigate today. I'm definitely willing to see what the daily candle closes will look like, and if we actually going to confirm them by tomorrow, or if today is going to be a huge bullish candle just violently invalidated tomorrow by some very rapid moves. We've seen that multiple times to the upside, in which Monday was a seriously bearish day, and actually turned out every Tuesday was definitely invalidating all about it, making bullish engulfing structure. So we could see the exact opposite thing right now. Bullish Monday, definitely bursting a lot of bullish emotions just to fuck it all up by Tuesday. So yeah, I would definitely require confirmations for those things before actually deciding to cut all of the bearish remaining positions. Other things I'm looking at right now is where I think the smart money is definitely at play, which is this spread chart. So I can definitely see that something is going on in here. 2 sets of waves going to the upside. I was questioning myself whether this was a mature range structure, whatever that was. So I was looking at this area and actually tried to validate, but got invalidated later last week. That's the reason why I got out, by the way. and cut all the bearish positions on the Nasdaq. Until further notice, I'm just waiting for all the trend line support. As long as we're dealing on top of them, I think this is the area we could try to reach out to. Don't make too much technical analysis from a spread chart, but normally speaking, when the market has gone down this way, means normally we need at least 61% Fibonacci's to actually consider getting it back in. So I think this is where the smart money is going to play once again. Remember, I don't think the smart money is making either bullish or bearish calls. I think the smart money is just spread betting and smart managing between ranging activities in which just the dumb money is either buying or selling. As we can see, we're definitely 50% sentiment, closer to 50% retail traders exposition, and whatever happens next, even if that's bullish reactivations, they're going to sell, and if that's bearish outcome from these ranges, they're going to buy the shit. They're going to do the exact opposite of what needed to be done. So I think using the sentiment right now is definitely not good. I think we need to use smart sentiment, and I think the smart money is definitely going for some range trade, which means they're arbitraging the market. They're taking hedges, one buying entry, one selling entry, and trying to profit from the spread. I definitely can say that they will probably start locking on the Dow Jones to Nasdaq spread charts rather sooner than later, but I'm looking at it. I need signals. So far, all I can see is early testing signals. They're probably starting to get in, but real slowly. Though waiting for more appropriate context to deal with that. Until then, the VIX, definitely not bullish. We look for it, we try as hard as possible, but the VXN, oh man, this thing is huge. If this thing actually manages its way down, there is a massive consolidation down the road, which means we could go right back into the bubble, which I sincerely doubt, because once again, a lot of people just are so biased right now. We do have higher low points and higher high points. Oh man, this is a bullish trend, right? At least that's a sign of bullish trend. So in these things, we generally get to buy supports. We do have ascending supports in here. Normally, this type of market has much more potential to go to the upside. Trending moving averages go to the upside as well. So yeah, I'm sorry to say it, but we're not in a bearish mood into this market. We could be, but we definitely have to show some strength out there. All I see in the meantime is just an ugly fat triangle. So we'll see what that is, but normally triangles are extracted into the side of the moving average. So if we were retracing out there, which means just a little bit of volatility from the text, and I think this area wouldn't be any resistant. But until then, it goes down, and when it goes down means if you're selling, you're stupid. So I'm waiting for appropriate timings to get back into this market. Until then, all I see is just some ranging activity. So we're going to try framing those range. I think that's the most appropriate thing to do. Until then, we also look at this. As long as this doesn't break any of those levels, this one, or actually I would say this one. So here are the latest validated boundaries we've got on the lower time frame. So, and this one. So as long as we don't break this with a daily candle close confirmation, there's nothing to actually price in any way. Okay, so we need to get out of this first, and then we need to confirm, of course, but that would be a totally appropriate sign. If we want to go to the upside on there, which means shrinking yields once again, we need to break this level. If we want to increase yield and therefore signaling that risk is still down the corner, we need to get there, okay? We'll see all about it. Until then, totally ranging, totally stupid, which means this is not where the smart money is looking. I think the Nikkei, just like we said, is where the party is at play. We're in a range. The range is mature, which means accumulations and breakout can take place. We do have an accumulation in here, definitely do have. We also see that we might have breakouts. Okay, we're breaking both the resistant context and the trend channel, but this is where the problem actually settles. We haven't yet broken the third range boundary. So in order to get out of this range, the Nikkei has to break this level. If it fails, that is a fake breakout, which means immediately we're going to break this level. That's one of the experience patterns I'll teach you later on. But if we were to fail in here on the Nikkei, huge resistant cluster down the corner. If in here, we'll load it on some buyers and we fuck them all up, which means this breakout has to be a trend breakout. If it's not, the next target is right down there, and I doubt we'll get to buy out here. All I feel instead is that, oh man, we're going to bring this to 4-hour chart type of range, And just bear this one in mind. We are ranging 4 hours for just the entire summer. So if we were on the verge to create a 4-hour time frame range, I think this is where we're going. Okay, previous resistances and stuff like that. So yeah, I'm not yet totally decided at the moment. I'm definitely dancing between two very opposite type of scenarios. I can hardly see how we could reactivate bullish out of there without actually not a single bullish momentum indication. We do have a lot of problems with coronaviruses in Europe, and I mean, there's just not a single bullish opportunity out there. We've reversed the context on the Nikkei. So we're dealing with resistant context earlier this week. If we are on the verge to reverse these things, oh man, people would just be buying the resistances. So yeah, multiple factors leading me to believe that something is going wrong earlier this week. The fact that the Nikkei isn't following its brothers to the upside is a very concerning signal. The fact that if I have a look at this, we're still dealing with 38% Fibonacci retracement out there. So lots of people are boasting for bullishness and stuff like that, but oh man, just have a look at technicals once again. Technicals doesn't lie when you have a look at all the same, when you're looking at the same signals all over again. Okay, I'm always looking at the same things. When you have a bearish move in average, when you have this type of breakouts, oh man, when you have this type of context, that definitely states that trend could be at play. And we're just dealing with 38% Fibonacci retracement, and people are calling for bullishness. Jesus, motherfuck, this type of things are generally trend following opportunities. So what really bothers me right now is the fact that the market is at a huge bias, because people think that breaking out of this is a huge bullish signal. That's a bullish breakout opportunity. Now, when I question these people, and if I just show them these charts, they would say, oh man, we're here, huge support. Okay, we can buy out there, put a stop loss below this low point, and as you can see, we do have a safe target. All the bulls confronted to this type of market would buy that. So my question is, how can you buy a market if it's the same thing that I just reversed? I think there is a huge bullish bias in the market right now. Absolutely dangerous. People have been basically brainwashed to buy the thing no matter what. They just been taught bullish patterns and bullish patterns after bullish patterns, and they basically just are all about highlighting those bullish patterns. So what I would tend to say is that those patterns you've learned, they're actually flashing to the opposite directions. So like I said, I don't know what the future is all about. All I know is that there is an absolutely interesting trend following opportunity into the nearby area, but that is something I can only want to deal with experienced traders. This is very tricky markets. We're following on some very mixed sentiment feelings and stuff like that, very emotional market. So yeah, the only thing I would say out there is be real cautious. So that's the reason why we're going to go straight to conclusions right now. All right, technicals are very mixed. We're definitely into an area in which something could happen. So this is a speculative area, but the thing is that speculative areas doesn't mean selling is absolutely necessary, and you don't anticipate signals out there, but we're definitely into a cluster everywhere. The S&P 500 is reaching out 38% Fibonacci retracement, just like the Nasdaq is doing. Okay, we do have Nikkei that could be on the verge to fail its breakout. If it succeeds, then of course I'm going to cancel all the bearish positions, because that just makes absolutely no sense to be bear in a market that goes up. But I don't think that's the case, because I see absolutely no confirmation from the correlated asset signals. I don't see a bullish outcome coming for Eurodollar or USD/JPY. I don't see a confirmation coming from the junk bonds. I don't see a confirmation coming from VIX or VXN. I don't see any confirmation coming from the 30-year bonds. All I see so far is just testing levels that could very well be resistant. And if they end up being, then we'll have the top of our ranges and probably the top of this week's candle. And until then, the only thing that we've done on just one day is gapping up and retracing to some areas that might be causing some reverse. These reversals, if they want to be traded, can only be dealt with experienced traders, because anyway, these are trend following opportunities. And moreover, aside from trend following opportunities, they are much trickier than that, because they can only be trend follow if the previous movement we have of V-shaped reverse. So if we actually build monthly and weekly reversals on the top, which is once again a very complex scenario to navigate, because of course this V-shaped reverse can only occur when the market has gone excessive. Have we gone excessive? Yes, we did. But does that mean we absolutely will V-shaped reverse? That's definitely not the case. So you need to understand that whatever is at play right here, right now, is dangerous to navigate anyway. That's why only experienced traders can navigate this, because if you're wrong, you need to be available to cut the positions without second thoughts and stuff like that. This is a very tricky mindset for beginners. So just set aside for a little while. I know how complicated that is to say, oh man, it's too difficult for me. But that's probably the smartest choice you could do out there. This is really dumb money driving the market sentiment at the moment, and you definitely don't want to be among them. So I'd rather like to see what this thing leads us to. And I'll just follow accordingly. Apparently, yes, last week's bearish breakout opportunities have totally been invalidated, and we're now surfing on this wave of bears were wrong. Let's try to see if the bulls will make it. I feel like the bulls will fail just like we did. And if that's the case, then we'll have range boundaries. But the problem is those range boundaries have barely retraced 38%, which means if we actually fail out there, it's going to be a trend following opportunity. Okay, but in order to succeed, we need to reverse out there. In order to reverse, we need to see signals, and so far we've got nothing but just a bam, flat upside trend. So short-term movement is all what this is about at the moment. Monday opened with gap, straight line type of momentum. This is not the type of things you sell. So experienced traders only, step aside for the others, and wait for later during the week until we actually get either confirmations or stuff like that. Until then, just wait. I think that's the most appropriate thing to do for less experienced traders. Experienced traders will meet into the Discord and we'll get to talk about everything we can actually do into this market, buying, selling opportunities. We'll manage both of them, of course. That being said, I wish you guys a pleasant week. See you later.